You at home? I hope you're okay too. We've got a lot of content to cover. So what are some of the reasons that people do an IPO? Sometimes it is the Zuckerberg problem, getting to that point where actually you've got so many shareholders, you need those shareholders want to be able to freely trade their shares. So it's providing an exit or a liquidity event. It can go to market credibility. It can go straight for just this is the next step in our journey. It can go to accelerating growth. There can be ego in it. There can be all sorts of different reasons to do it. Listing is not for the faint-hearted. It is not for the secretive. It's not... one of the things... So my business partner, CEO at Tomacom, he actually likes being listed. I think partly it does suit his ego, I will give him that. But he actually finds it very stressful keeping secrets, in the sense of there's the stuff I can talk to the board about, but I can't talk to the other shareholders about them. And he finds that, down the pub, a lot of the shareholders are his mates. He finds that really difficult. So once he's in the continuous disclosure regime, he's got a framework around which he can say, well, I can't talk to you about it and listen until it's in the market. And he's happy to go and disclose news, good or bad, really early, because he just likes having that kind of discipline around how he works. I think too, particularly if it goes well, you can feel pretty good about yourself. If people in theory think that you've got plenty of money because they can guess at how many shares you've got and they can see what the share price is. Of course, share value is only really relevant when you can sell, and particularly in small cap companies, you don't have to sell very many shares to remarkably impact the share price. For every seller, you need a matching buyer. And so if you've got more sellers than you have buyers, then the price goes down. And what you're looking for is a market where you've got more buyers than you have sellers, so that the price will go up. So it's not always as easy as just saying, well, this is what your value is, but it does give you a value there. It also makes it often easier dealing with landlords, dealing with unions, dealing with employer groups, with industry. It gives you kind of a benchmark. There's a range of different public measures that these people that you need to deal with can see and can react to, and you have got a basis or an ability to confine information and say, for example, well, I can't give you that information because I can't breach the listing rules, or we're a listed company, we don't give directors' guarantees, those kind of things. That is a very faint slide, bad colour choice. But some of the things that are good about it, certainly one of the reasons both of the companies that I've been involved in have listed as one of the driving forces behind that strategy has been our customers work in equities markets. They understand that gives us credibility in that space. It gives the transparency that they need. So the market awareness is really helpful. It provides some incentives for remunerating employees. Employees can see that the work that they do directly or indirectly impacts the value of the shares that they hold. It does provide an opportunity for founders to get out. Sometimes that's more theoretical than it is actual, though. If a founder, so if Mark Zuckerberg was to go and sell a big whack of shares tomorrow, the whole market would be thinking, what does he know that the rest of us don't know? And it's certainly, once you are listed, it is much quicker and usually much cheaper to raise additional capital going forward. I think market awareness on one side is a pro, but is also a con. The fact that your competitors, the fact that your suppliers, the fact that your customers know everything about your balance sheet and your P&L can in fact be as advantageous as it is intrusive. You are vulnerable to the market. I think I said in the first company that I was really intimately involved in, at the end of the day, the impact on the share price was more to do with what was happening outside of the company than the company's own strategy and growth. So in particular, when the company was trading, we'd been listed, I think, for about 2.5 years. The GFC had started. We were trucking along quite nicely. I think our share price, and we listed it at about 40 cents. At that time, the share price was sitting at about $1, sort of leading into the GFC. It's been heading downwards. I can't remember exactly where it was. Probably down around 80%. So compared to the rest of the market, we hadn't struggled too much, but we'd been kind of priced out because we're a little techie company, not very exciting. But in the lead up to the GFC, there was a lot of speculation on the market. So a lot of people were buying shares and borrowing money to buy shares as well. In the 12 months before the GFC, there were some changes to the superannuation legislation that allowed self-managed superannuation funds to borrow money to make investments. That played out in two ways, and it's been tightened up since. So some superannuation funds were buying residential property, which is a very stupid thing to do in a self-managed super fund, if you ask me, and I can explain that later. But they were also borrowing money to speculate on the stock exchange. So when you borrow money, you are often required to provide a security for that money, and there are a couple of small lenders that were agreeing to take security on shares that were not in the S&P index, so not your blue chip shares, but shares at the specky techie end, and they were effectively taking mortgages over those shares. So one of those companies itself was being funded by ANZ, it was at the time, a bank, and the GFC happened and credit tightened up a little bit more, and then on one particular very fateful day, ANZ decided to call in the security that it had for the main financier of all of these loans in the specky techie stock area, which meant that all of these shares that were being held, which included in the order of about 5% of premium stock at the time, so 5% of the outstanding share capital, had actually been pledged by different techie investors. We didn't know this. By this particular, to this lender, who in turn had pledged that stock to ANZ. ANZ put it all on the market in one day. So I can't remember exactly how many shares we had on issue. Say we had 100 million shares on issue, and 2 million shares went for sale at market price in one go. Now, it wouldn't even BHP, if you put, even though 2 million would be way under like 1% of their, and if you put 2 million shares in one parcel at market in one go, the share price would be radically affected. There were a number of companies, Praemium was not the only one, and share price just plummeted. So I think we actually found somebody to mop up some of those shares, but then there was no more appetite in the market. So share price basically went, in the period of a year following the GFC, from $1 something to, I think at the lowest it got was about 8 cents. And it sort of bottomed out ultimately at about the 14 cent mark for a very long time. The company fundamentals were exactly the same. Company was growing, wasn't exactly profitable at that stage. Of course, raising money suddenly became a lot more expensive than it ever had been. There's lots of different changes. So all these things that happened from the outside, which if it had been a privately held company or a closely held company, not listed, would never have been exposed to those kind of risks. So
how come the company didn't go into trading hold? Just explaining to the market what's going on.
Well, trading hold is an option. At the time, we didn't even know what was going on.
Okay.
Nobody knew what was going on, and it happened. And ASX has to agree to a trading hold. And at the time, so in the end, actually, interestingly enough, the financier sued ANZ and ultimately was successful for the way that they managed that, which was great for the people who had those shares, because they basically got a settlement that was in the order of 80% of the price, the value of those securities on the day that they were taken away from them. But it didn't, because it's a perfect storm of a whole lot of different issues. Like, it was a fairly dramatic one. At the end of the day, ASX is not going to halt, the bottom 10% of the market. It was happening all over the market that particular day.
Yeah.
So a trading halt is something a company can, once it is actually listed, can go to the stock exchange and say, there's something happening. We are at risk of the market not being properly informed about what's going on at the moment. Or sometimes it's just, it can be in response to an economic incident. But on the whole, it's like in the lead up to, say, to a takeover announcement being made, or a change in control or something, a big acquisition. So something that, if it got out into the market, could affect the share price, but you don't have full information yet. You can go to the ASX and you can ask them to halt trading pending an announcement. And usually they will, not always, but usually they will. So I guess that story then is also an example of loss of control. So once your shares are listed, you have no control over who buys them and what happens next. And there is increased exposure for the directors. I mean, even both at a technical legal level, but from realistically, there is increased exposure. If we have, even if all of us around the table and elsewhere were the shareholders in a company, we could get together and have a meaningful conversation about an issue, and there might be some fist pumping and some door slamming, but we would have one conversation. When you have, even at the minimum to get listed, about 350 shareholders, realistically, you can't have a conversation with 350 people. And so if something goes wrong, you've got relationships with people, you can usually work it out. If something goes wrong and you've got 350 or 350,000 or 3.5 million strangers who have invested in your company, one of them just might sue you. So even if you are in the right, your exposure to actually being in litigation is exponentially increased by being listed. Am I making it sound fun? This a little bit hard to see. I've taken this from what I think is a really useful thing for you to have a look at. There's a few of them again on the ASX website. I had some involvement in the preparation of this one, so that's the one I've put up. But there are a number of law firms put up listing guides and information about how to get listed and how the stock exchange works on the ASX listing website. And this basically shows a rough timeline for getting yourself to listing. It suggests that you can go from beginning to end in about a 4-month period. I have never yet been involved in one from beginning to end that has been done that quickly. 80% of the work is done in that last month here. Oh, sorry. New share a slide pack, have to open something up, is done in this last month here. This is where everything comes together and the kind of 80-20 rule applies. You've done 80% of the work, but you've got very little to show for it. Then you've got to document it, make sure it's consistent, and make sure it continues to be true on the days that you sign off. So a lot of this work is about building the prospectus and getting the structure right so that you can make that application for listing. So, what do you need to include in a prospectus? Frustratingly, even though I've shown you one, and I think I could have shown you any of the ones that were on that list there and they would have looked remarkably similar to each other, there is very little specific prescribed content. So Section 710 is the key provision here. It says that a prospectus needs to contain all of the information that investors and their professional advisors would reasonably require and reasonably expect to find in it, and in order to make an informed assessment of the material matters relating to the company, including the assets and liabilities, financial position, profits and losses, and prospects of the company. And then secondly, the rights attaching to the securities being offered. Now, it's interesting to me that the second part of this is actually rarely part of the commercial discussion. That's the stuff that the lawyers just document, and it's largely boilerplate. So you'll see in the additional information section in most prospectuses, there'll be a section there that says rights attaching to the securities. I'm going to deal with it quickly because it's kind of the least interesting and we'll get it out of the way. This is the section of the prospectus that will say you get 1 vote a share, that you've got a right to attend annual general meetings, that you've got a right to vote for the director, you've got a right to get documents on paper form if you want to, but we're going to default to something else. It's pretty stock standard stuff. So the magic in the provision here is it's very open. It puts the focus on the people who are putting this document together. So the issuer of the prospectus, that's the company, and the promoters of the issue, that is the directors of the company, and any underwriter or broker that's associated with the promotion of that issue, have a very high qualitative set of obligations. So it becomes a kind of an objective test that investors and the people who advise them, the stuff that they would reasonably require. Now, if I'm an investor, I think it's quite reasonable for me to say, I want you to tell me whether this is going to make money or not. I want you to tell me, is this a sure thing or not? I want you to give me really accurate information. So we need to look at this. So we need to talk about what the assets and liabilities of the company are, what its financial position is, profits and losses and prospects. So it's profits and losses in the past and what its prospect, whether or not it is likely to make a profit. What are its prospects? What are its future plans? The question of prospects is often one of the most difficult to deal with because, well, I don't know what you think, but do you think that provision suggests that you should include some kind of forecast or projection of what your future profitability might be? Yeah, I do too. But particularly companies going in under the assets test, I didn't look for it, but I could pretty much guess that in that prospectus that we were having a look at would not have contained a forecast. And Domicom, Premium, neither of them contained a forecast either. At best, there might have been, and the words that you use, that the law uses, a forward-looking financial statement. Where this, and we'll get to the relevant provisions shortly, but this dovetails into the potential for there to be an offence for including misleading or deceptive information in a prospectus or in relation to the sale or issue of a financial product. So if a forecast, which really is a guess about what the future might hold, turns out to be incorrect, and the only thing I can say for sure about every forecast I've ever seen is there'll be something incorrect in it, you're adding that level of liability. So again, the way that the law ultimately works is if you can't make a forward-looking financial statement that would meet the requirements in relation to the accounting standards of being based on verifiable assumptions, effectively using the past as a way of demonstrating what growth might look like, then you can't include forward-looking statements of any kind. Most people don't want to include projections, even if they've been profitable for a really long time. But also the way this section works is, because it's looking for prospects, if you do have verifiable assumptions, if you do have a reasonable basis for projecting what the future might look like, then this section says you're obliged to do so in a prospectus.
You can almost see it would be where it's a very large price and it is very much attached to, for example, dividend investment.
Yeah.
So when they issue Cathryn shares, when they issue Fire shares, I'm pretty sure they had forward-looking.
Coles had a forecast in it. Most companies that go in under the profits test would have to have a pretty good reason for not having a forecast. And as we look at the other kind of transactions we're going to look at over the course of the following weekend, you'll see that there will be prescribed requirements to include forward-looking projections in, or forward-looking financial statements in relation to some kinds of information. So what's the consequence of this deal? How is it going to impact our company?
Yeah, they can put all of those forward-looking statements there, at the forecast. At the same time, they can say, it's subject to market condition and.
Oh yeah, well, there'll be every out under the sun there. But at the end of the day, we're juggling these two. My point here is not as much around the detail as these two policy issues that are being juggled with. One is we've got this disclosure regime, a regime that is built with this assumption or this understanding that a way that we can prevent investors from losing money or from making bad investments, is by giving them as much information as we possibly can about the risks, the problems, the potential, and making it a transparent disclosure environment. So we've got this disclosure requirement on one side, and then on the other side, we brace that with thou shalt not be misleading or deceptive. It doesn't matter whether you intended to mislead or deceive people. It is a straight-out prohibition. It's pretty much exactly the same as Section 18 of the Australian Consumer Law. It's exactly the same wording as the old Section 52 of the Trade Practices Act. All of the law that looks at the interpretation of those words in those two pieces of legislation used in relation to the relevant provisions in the Corporations Act and the ASIC Act. Thou shalt not, in offering or issuing securities to people who are not sophisticated or professional investors, do or say things that are misleading or deceptive. So you've got to tell them everything, but you've got to make sure they're not misled or deceived. And it's not always a comfortable alliance. So we've talked about what they look like. We talked about materiality the other day. So in order to prepare a prospectus, basically what the company has to do is to get all of the information required to meet that requirement, to tell people about the profits and losses, the prospects, the risks, etc. So in order to do that, without actually just drowning people in information, we've got to work out what the material risks are. So actually, let me just have a look at the words again. So to make an informed assessment of the material matters relating to the company. Okay, so that's what we're looking at doing. And so we need to the company, one of the first things it needs to do is identify what does materiality mean. We spoke about this yesterday briefly. Generally, we look at both a qualitative and a quantitative test. The accountants and the auditors will usually be asked to give what I think is the easy thing, the quantitative test. What numbers, what kind of numbers are we looking at? And then usually the lawyers are asked to help with wording this idea of the qualitative test, something that people would reasonably expect to know about. So this is why risk factors get so bizarre and long sometimes. So, I would think, for example, if you had a company that was buying inputs from another country and maybe selling them into a third country, it is reasonable to assume that its profitability when counted in Australian dollars might go up and down depending on the relative values of Australian currency to the currency of the places that it buys things from and sells things to, right? Mining companies, there you see all the time, their prices are going up and down because on the whole, mining companies sell things in US dollars. So when the Australian dollar goes up in comparison to the US dollar, mining company profits go down because they spend money in Australian dollars, they earn money in US dollars. When Australian dollars cost close to the same amount as US dollars, the difference is less. Mining profits go up when the Australian dollar goes down against the US dollar. I'm thinking that's not too hard to understand. I think if you're a big enough human to be able to put $2,000 into a prospectus when you're buying a company and you know that it sells things somewhere else or it buys things from somewhere else, the chances are its profitability might be impacted by currency fluctuations.
So I put that in the company specific risk.
Yeah, but you will pretty much always see currency risk. Always. You will have a specific, and it might have a lot of detail in it. It will take up quite a lot of space. Very rarely tells you anything real about what they do. Often the real risk when you have currency fluctuations is how are they hedging? What are they doing to mitigate that risk, and are they taking risks by mitigating that risk, or are they not hedging? They're often quite silent in relation to those things. So sometimes there's just everybody else does it, so it's reasonable to expect that it should be in there, so we better put it in as well. At the early stage with deciding that you're going to do a prospectus or do an IPO, one of the first things that often happens is that you'll bring a due diligence committee together around a board table. You probably need a table about the size of the one that we've got in this room. You'll have some key management staff, executives. Usually you would want pretty much the whole of the C-suite, because if your job is important to be chief of it, chances are it's important to the way that the company works. So usually you would have at the very minimum the CEO. You will have the most senior finance person, so usually a CFO or something similar. You will have, in almost all cases, you would have a person who is most senior in relations to sales, if that's not also the CEO. So that's, for some reason, they seem to overlap. If you have a human resources or an industrial relations person in the executive, that person will almost always be there. If you have any kind of intellectual property, R&D, specialist intellectual property, the inventor or your key scientist or whatever, the most senior person in that team will normally be there. If you have in-house lawyers, at the stage of going to IPO, that's actually relatively rare to actually have an in-house lawyer at that stage, but it's not that it never happens, particularly if you're going through on the profits test and you've got a large operating entity, you might have an in-house lawyer. In that case, it's unusual that they would have IPO type experience, though they'll tend to be, operational, leasing, industrial relations, that kind of thing. So bring all of those people together. So you've got a fair whack from your management team. I suspect a smaller whack from our 2 employees from the prospectus that we've had a look at, but you never know. You would have the auditor in the room, and you will usually have an independent financial advisor as well, maybe from the same accounting firm. So you've got the auditor who looks at the past, and then the person who's helping you with the valuation and putting together the pro forma for future-looking accounts, and also with the tax and other kind of structuring. You might have a separate tax person. You might have a separate employment or industrial relations expert in the room. You will almost always have a broker or an underwriter. So that's an independent promoter of the business, usually almost always somebody who has a financial services license that allows them to advise and put together these kind of transactions. They'll be responsible usually for marketing the issue, for finding sub-underwriting, and ultimately for shepherding the investment process. So they're the ones who have the connections to the investors who are going to get in. Each of them will have separate areas of interest. Usually the lawyers will take the lead in relation to the creation of a due diligence committee. So the due diligence committee will have the job of making the investigations to ensure that we meet the requirements of the section, that we have told the prospective punters everything that they could reasonably, or they and their advisors could reasonably expect or request to know about the company, its prospects, its financial position, etc. So that due diligence work plan will usually be about identifying what's the most important things. And it will range from trawling through documents, second guessing, doing little sort of spot checks of different areas where there might be risks to just ensure that there are none, and interviewing directors, staff members to really look for those risks. I've put a full quote here from PwC's. It's quite old now, but I bet the quote's in their most recent version as well. Typically, materiality thresholds for prospectuses are set at somewhere between 5 and 10% of a representative profit and loss and balance sheet measure. However, even if a matter falls below the threshold, the committee needs to consider whether it's qualitatively material. That is, the information could impact on a company's reputation in a significant way. The Corporations Act states that a reasonable person will be taken to expect information to have a material effect on the price or value of a company's security if the information would be likely to influence a person who commonly invests in securities in deciding whether or not to subscribe for the company's securities. So there is a benchmark, but really I like this because I think it's putting into one place, and even though I've misquoted while reading the quote, it's demonstrating that even if you're on the numbers side, you need to be looking out for qualitative risks. Back in the late 90s, I did a number of floats of what were called at the time red chip companies. So they were companies that were incorporated in Hong Kong or Bermuda often, and they owned assets that were in mainland China. And some of you might remember, up until July 1997, Hong Kong was a British colony. It wasn't part of China. And so often Chinese people who lived in Hong Kong owned these companies, but there was a lot of concern at the time that when China took over Hong Kong, that the economy might change dramatically, as it turned out it did, and up until recently, mostly for the better. But there was concern that there could be a huge downturn. So in the lead up to 97, there were about 14 or 15 from memory red chip companies, as they were euphemistically called, that ended up floating on the ASX here. And so one of them, one of the famous ones, there was a bit of an undoing of Jeff Kennett over one of them. So Jeff Kennett was the premier at the time, and about a year or two after 97, it came out that because there was quite a big jump in the price for a number of them, particularly the early ones, and he got an allocation of shares in one of the early floats after an announcement had been made to the market that the allocations had closed. So it was quite a scandal about it at the time. And that was probably the last of the ones that were successful. Subsequently, there were quite a lot of doggy red chips that hit, and they spent quite a lot of money, and then turned out they would have been better staying off where they were. But anyway, so this particular company that we were looking at, it had some technology assets. Actually, it owned like an industrial park that was looking at doing technology developments, and it was outside of Beijing. and it was called the Beijing Silicon Valley, like in Chinese, but that's what it was called, Beijing Silicon Valley. This is the late 90s. And so we've gone through, I've been there, I've looked at things, I've kicked tires and lifted skirts and done all of the things you need to do to verify that the asset really exists. And then we're back in Hong Kong around a boardroom table like this, but more shiny gold things. And we're going through the prospectus at the end, and I am reminding the directors there of the difference between the quantitative and the qualitative rules. And so we've identified all of the qualitative potential issues. And so one of them says, can you explain to me again what you mean by a qualitative factor? And I'm thinking, okay, well, let me give you an example, something that might impact reputation or impact the quality of the branding, or something that we don't expect, we can't put a number on. So say, for example, there was another Beijing Silicon Valley. And they go, oh yeah, there is. Like, you know, I'm getting a bit twitchy, like, what? Yeah, oh yeah, there's a few of them. Like, there's a lot of places that are called Beijing Silicon Valley. And it's just like, everything's just, you know, like the whole room is spinning at the time. So yeah, we had to make some fairly hasty last minute changes, because a lot of the way it was written was sort of consolidating this brand. And when you made inquiries, you know, whether Beijing Silicon Valley was a thing, it was certainly a thing. It's just our thing wasn't the thing. So again, it can happen really easily. And again, communication. And we were dealing with a number of different languages for what it was worth, but sometimes too, you really do need to ask direct questions. So, due diligence. Due diligence is like the stuff that young lawyers are made of, I know. It is underpins and is a large part of the work involved in getting a prospectus right. ASIC did a fairly large research piece on due diligence back in 2016 and identified a clear link between gaps or issues in a due diligence process and effective disclosure. So in particular, and again, there was a lot of pointing of fingers at our friends in Western Australia. Hello to any of you out there. I don't know whether we have Western Australians in this group or not, but you seem to be getting a hard time. Stand up for yourself soon. So part of this was about making sure that due diligence isn't just a box-checking exercise, that it's not just about gathering data, it's about making sense of the data. And it demands active involvement and engagement, not just by junior members of the accounting and the legal team, but by senior members of the company executive and the board members as well. So it is a market practice though. It is, even though we talk about the due diligence defence, and I will get to that, I promise, it's not itself strictly a legal requirement. It's vital really to ensure that the information that you are producing is correct, or as correct as it can possibly be. And it provides those who are involved in preparing the document with what is at the end of the day relatively limited defence in the event that a prospectus is defective, or that it doesn't actually include the disclosures that are required by 705, or that it is in some way misleading or deceptive. So when they did this research, they found a number of things, and they made a number of recommendations. Again, I haven't actually done a prospectus due diligence since this research came out. Most of the processes I've been involved in, all of the processes I've been involved in, they've had their quirks, but they have been robust. So I think this is likely to pan out. It's not so much that's going to change industry practice, but that one of the first things ASIC is looking at when it audits or spots checks the background behind a due diligence activity is it will look to what was the process and was it actually followed. So what does it actually mean? It's usually, like I said, you bring everybody together like a committee, but then everybody goes off with their respective tasks that they need to do. And then they come back and usually report by exception. Like if you reported on everything that you found and you learned, nobody would ever be able to read the whole of the report, and it would be very, very expensive to compile. So by understanding what materiality factors are, then we can actually identify what things have fallen outside of the thresholds that have been chosen, come back to the whole of the group, explain that thing, and then a decision is made, usually around the table. Do we fix it before the prospectus is issued, or do we disclose it, or is it some combination of those things? And often, because companies want to raise the money, they want to look clean, they don't want to show the world their dirty laundry, a lot of the work in leading up to it, getting a prospectus right, is also about fixing things along the edges, making sure that things that they might be done right but not documented, or they're documented in one way and done in another way, making sure that those things are actually fixed. What's really important in this process too is ensuring that the due diligence process doesn't just stop when the prospectus is lodged, because the obligations, and we will get to them, include disclosing to the market if there is something that changes that could have a material effect after the prospectus is issued. So when I was telling you the story earlier about Domicom, one of the timing factors there was we've got to work out at what point we know exactly what the situation is before you launch. And so some things you're waiting on decisions, like what's a referendum going to be in the UK in relation to Brexit, because the outcome of one thing can absolutely change fundamentally the way that you've written something about your prospects in a document. So otherwise you're going to have to provide updated prospectuses, etc. Another thing that ASIC found was that there were problems that arose as a consequence of the attempts made to save costs, which lead to cutting corners. They also found that many investigating accountants, or most of it, a high standard, but there was a big difference between the various layers of so between the first, second and third tier. So they're inadvertently or indirectly recommending, if you are going to go with a prospectus, you need to have a brand name accounting firm, that you're not going to go with, Lygon Street Accountants.com. Another problem that arises quite often was poor oversight of foreign due diligence. They uncovered a number where there were foreign assets that nobody had ever gone and had a look at. Luckily, I like travel because I spent lots of time going to foreign places to look at assets, but they weren't always pleased to be seen. Other problems relate to box ticking, focusing on the form, focusing on getting the due diligence manual or the pro formas right, rather than actually thinking about what the data means. So recommendations there require that your due diligence process really needs to be thoroughly documented, planned, mapped out. Planning is all one thing and it's well and good, but unless you actually implement it, there's not much more you can do. The fourth and the last lot of problems that they identified were directors that were demonstrating only superficial involvement and really relying on others below. And ultimately, as it's the directors who are taking primary responsibility, delegating out that authority really creates, or responsibility can create huge gaps. Some of the comments in the report from memory included issues, particularly when directors didn't speak English and all the reporting was done in English, and thinking about particularly as, business is very multicultural these days, making sure that relevant and important information is appropriately translated and provided. So John Price, who was the commissioner responsible for that report, said directors are important gatekeepers in our financial system. The effective performance of a director's role involves much more than compliance box ticking. Rather, it requires directors know their company and employ an inquiring mind. Again, to those of you who've done company law, this will not surprise you. My guess is at least a third of that course is ultimately about the duties that directors have, right? And it can scare the bejesus out of you from being a director, let me tell you. Forecasts. We've spoken about these already. Not much more to add here. We tend to talk about them as forward-looking financial statements. And I have a general sort of test there, but I'm looking quickly. I don't think there's anything in there we haven't already spoken about. So we get to the end of this process. I've made it sound easy, possibly a little bit boring. In fact, it's hard and, in my view, very interesting. Due diligence, actually, when you think about it, if we've got our little robot business here and we're trying to raise a whole lot of money, as an executive team, one of the things that we're really keen to do is to make sure that that business looks as good as it possibly can by the time we're issuing our shares, right? So which means I want my executive team to be spending 100% plus of their time in the business, on the business, growing the customers, sorting out problems, dealing with that. But in fact, what I'm going to do is overlay instead this massive compliance due diligence program where they've got people who are actually being paid quite a lot of money actually to come in and ask you about all of the bad things that haven't even happened yet, right? So actually it can be quite a chaotic time. People are absolutely exhausted. Your clients want it to happen as quickly as possible. The longer it draws out, the more potential there is for change, which means it draws out longer and longer. So you want to compress the activity in as to a shorter period of time as it can. Also, you've got think about it, this many people around the table that we have now, those of you at home, just imagine there's quite a few, all involved in putting together one document. Just think about group reports that you've ever done. Have you ever really felt when you've written a group report that at the end of the day it's all come out consistently in one voice with consistent terminology, and that you're absolutely sure that all of the relevant information got in there in a sensible order? Like, that is really hard with 4 or 5 people, right, who are doing nothing else but doing that thing. When you have got people who are trying to run their business, you're trying to reflect all of this in the document. You've got lawyers and accountants who are saying, hang on, we've got liability for issuing this document too. We want it to be as vanilla and plain as possible because we don't want to take on liability. Let's make it as sort of dry and boring as we possibly can. They don't use that word, but that's kind of what they mean. On the other hand, you've got the person, often the founder, the people who are promoting the shares. We want people to invest in this, guys. So we want it to look good. We want people to identify what the great things about it. I've never yet met a founder. I think in order to be a founder, you have to really believe in yourself and your business. You actually genuinely have to believe that everybody else is an idiot and everybody else who's gone before you has been making mistakes and you are the one who knows what you're doing. And you're asking that person. So they want to write in a completely different style to everybody else. People get tired. They get offended when they see a risk factor that says this might not work. People at each other's throats. It is actually, it's a way more emotional and personally difficult environment than you would expect it to be. The only saving grace is most of the people are rich and there's good champagne at the end. I shouldn't really say stuff like that because it's not even really true. But at the end of the day, it's like, actually you can have some of the most robust and interesting arguments in that scenario, but I don't want you to think that it's just as kind of a mechanical approach at all. On the other side, why do I say it's interesting? Personally, I think I'm probably the world's greatest sticky beak. I like learning how businesses work, how people work, what their ideas are, and turning that into something sensible. So I personally loved doing due diligence. I've loved writing prospectuses. I've loved thinking about what risk factors would be. For any of you who are thinking about commercial firm work, a lot of people do complain about it. I think, commercial work, you're doing due diligence, you're learning all this stuff about people who can see a future. The alternative is you do litigation, you do a whole lot of discovery, which is just due diligence with a different name, and everybody's ready to tear each other's throats off. So personally, I'm from column A, but you might like to approach it differently. So when we get to the end of the process, we need to approve the prospectus. So that involves a couple of different stages. Traditionally, there's no law that says you have to do it, but most people will do this. So when they get their final draft, they will go through and verify everything in it. So think about the last essay that you wrote and how boring it was going back and trying to put in all the footnotes. This is the final bit on speed, because you've got final drafting. So by this stage, you've often brought in a copywriter or somebody to pull it together and make it actually sing. You've got design happening and all the rest of it around it. But if any sentence, any part of a sentence contains a statement of fact, then you are going and finding a piece of evidence that supports that statement of fact. You're putting it in a file and you're giving it a number and you're making sure that it is forever associated with that particular sentence. If there's a statement of an opinion, then you are classifying that, and somebody will go through the process of writing up a list of those opinions or a summary of those opinions, so that the directors, when they have the board meeting to approve the prospectus, can have a look at all of the opinions that are being credited to the company, which in other words to them, and they can go through the process and say, yeah, that is my opinion. Sometimes it's not their opinion, and then you go back again. But again, so it can get really tedious at the end, even though a lot of the work has been done. There's a lot of attention to detail at that very end. And usually then what we'll frame is we'll have a final board meeting. So the due diligence committee is almost always a subcommittee of the board, much like an audit committee or a remuneration committee.
Remember the United Petroleum?
Sorry?
The United Petroleum litigation that happened a few years ago?
I'm not, it's not coming to my mind immediately.
Very close to IPO, and the directors fell out over approving the final prospectus.
Oh, yeah. Was that United Petroleum?
Someone else.
I'm not sure.
Yeah.
But yeah, look, and it happens. There's not always litigation over it. But I would say for every prospectus that is in the market, there have probably been at least 3 board meetings somewhere where a prospectus hasn't been approved. Now, sometimes they will be board meetings in relation to a prospectus that ultimately gets approved, but there are plenty that get right to that last offer. And we'll talk about this next time when we're talking about auction processes. Often, particularly if you're spinning out an asset, you'll run parallel processes together. So you might be preparing to spin out to do an IPO for an asset or a business, and at the same time have it on the market for a private sale. So you're basically, looking at both strategies at the same time, doing the work for both, and the private sale will win out in the end or not. Just depends on how it works. So you've got your board meeting. So the due diligence committee will usually get to the point where they'll agree themselves that the prospectus is ready to go, usually at a final board meeting you would be presenting a draft listing application. So going back to where we were a few hours ago, there's literally an application form that has been filled out and all of the supporting evidence that goes with that. There will be a draft of that will include the draft prospectus. Tabled at that meeting will be the draft prospectus, usually a verification file, usually the due diligence reports, and the sign-offs or consents, usually not actually signed but in draft form, for all of the directors and those people who are going to be named in the prospectus to give their consent to being named. And so all of that will be tabled prior to the meeting. Usually, best practice is, as I'm sure you're aware, it's a good idea to give directors quite a bit of time to read things before a meeting. They, in my experience, never get it when we're talking about a prospectus because it's such a moving feast. Having said that, they will have had access to drafts and to memoranda setting out what the highlighted issues are for weeks, if not months prior. So a good, active, focused board, there will be no surprises at that last meeting. That's not always the case, but ideally that is what you are aiming for, that you've had your fight spot before you get to that final meeting. And then at that final meeting, usually there are a whole lot of things happening. Usually it can happen very quickly, actually, if everybody's aligned. You will have any restructure documents that need to happen. You might actually call a meeting of shareholders at short notice to change the constitution, to do a range of other things, to make it align with what you've been writing to. Depends on what transactions and what cleaning up you needed to do to get to the prospectus or to the application stage. You'll have your prospectus sign off as well. You will have it's often at that stage that you might appoint some new independent directors too. Often, new incoming independent directors don't want to take the risk on a prospectus until an underwriting agreement has been signed. Which makes me remember, I don't think I have a separate slide on underwriting, but I've used that term underwriting quite a few times. Are we comfortable with what an underwriter does and is? I know you will be. Why am I looking at you? So just in case, because I'm not getting eye contact with everybody, just in case. So an underwriter also has a Australian Financial Services licence. And underwriting, you hear that term in connection with insurance as well. But what an underwriter effectively does is they enter into a contract with the company under which they say, if you take this prospectus that we're happy with to market, and none of these things in our extensive list of things that might go wrong, in fact, go wrong, and it turns out that you're not fully subscribed, you don't achieve your minimum subscription, we will purchase any shortfall. So we are underwriting, so we are basically providing insurance that you are going to get all of the subscription. They will charge a fee for that. Often, I'm seeing more and more when you have an underwriting, they will charge a fee which is a percentage, 1% just for doing it, and another percentage for anything that they take up. So it means, say they take up 10% of the shortfall. So say you were trying to raise a minimum of $5 million and you raised 4.5 million by yourself, they actually had to put their hand in their pocket for 500,000. At that sort of small end of the market, if you were going to get an underwriting at that, it is likely that you would in fact have to pay them in the order of 10% just for underwriting it. So you would be paying them $500,000 for underwriting. And then when you didn't get the subscription, you would probably pay them another 5% on the 500,000 that you had to kick in, which effectively means that they're going to pay you 500,000 and you are going to pay them 550,000 for doing that, and they'll be pissed off because it's a bad deal for them. So got some nods. So that's basically how underwriting works. So underwriting is insurance. Underwriters will almost always sub-underwrite, and often that's the basis on which they'll sign an underwriting agreement, is that they've found other brokers who will sit in. Effectively, what they are doing in practice is that underwriters are usually associated with brokerage firms, and the brokers will basically get on the phone, find people who want to invest. They will take a clip, a percentage, so the underwriter will pay some of that 10% to each of the sub-underwriters for finding that. So every time you invest, particularly if your broker has recommended something to you through an IPO, some of the money that you're giving to the company is going basically directly to the person who may in fact be paying a separate advice fee to do that. Now they have to disclose that, but it is, there's lots of money being made in the buying and the selling of shares. Again, I need to make a prescribed reading. I would if it was copyright compliant. Wall Street, just understanding there's a great little scene in Wall Street where Gordon Gekko explains it doesn't matter whether the price goes up or down. All that matters is that people trade. that's actually how the market makes money. So often, that little segue was because often incoming directors will not actually agree to be directors until the underwriting is in place. So a lot of things can happen at that final meeting.